Good morning, everyone, and welcome to The Morning Bell. I'm Robert, and joining me as always are Lizzie and Steve. It's Monday, February the 9th, 2026, and we're looking at what appears to be a quiet day on the economic calendar, but there's plenty to discuss in terms of market positioning and what's ahead this week. Lizzie, let's dive into the news. We're seeing some interesting dynamics playing out, particularly around market sentiment, and what looks like a bit of a pause after some volatility. What's catching your attention?
Thanks, Robert. What's really standing out is this tension between short-term weakness and long-term positioning. We're seeing some notable capitulation signals, particularly in the Bitcoin mining space, where difficulty just dropped by the most since 2021, which tells us miners are under real pressure. But at the same time, we're seeing accumulation from long-term value investors and institutions. That dichotomy is important because it suggests the market is trying to find a floor. On the equity side, we had that tech earnings disappointment last week that rippled through the sector, and now investors are reassessing valuations. The interesting part is that while there's been some pain, particularly in high-growth names, the underlying fundamentals for many of these companies remain solid. We're in this zone where tactical weakness might actually be creating strategic opportunities for patient investors.
That's a good point about the divergence between short-term pain and longer-term value creation. Are you seeing this play out differently across sectors, or is it pretty broad-based at this point?
It's definitely more concentrated in technology and growth-oriented sectors. Consumer discretionary is showing some weakness too, which makes sense given the macro backdrop. But what's notable is that we're not seeing panic selling across the board. Instead, it feels more like a recalibration. Investors are getting more selective, focusing on companies with clear paths to profitability and strong competitive positions. The volatility we saw last week, particularly that sharp move down, and then the partial recovery, that's classic repositioning behaviour. People are taking profits where they have them and looking for better entry points in names they want to own for the medium term. The key question now is whether we've seen enough of a reset in valuations to attract fresh capital, or if we need to work through more uncertainty first.
Steve, let's turn to the economic calendar. We don't have much on tap for today, but this week is going to get busy pretty quickly. What should we be watching?
That's right, Robert. Today is essentially a quiet day with no major economic releases scheduled, which gives the market a chance to catch its breath after recent volatility. But starting tomorrow, Tuesday, February 10th, we get retail sales data where the market is expecting a reading of 0.4% growth compared to the previous month's 0.6%. So we're looking for a modest deceleration in consumer spending, which will be important to watch given the concerns about the consumer. Then on Thursday, February 12th, we have two significant releases, starting with initial jobless claims, where the forecast is 218,000 compared to the previous reading of 231,000, suggesting some improvement in the labor market and also existing home sales, where expectations are for 4.15 million units compared to the previous 4.35 million, which would represent a notable decline in housing market activity. The big day is going to be Friday, February 13th, when we get the Consumer Price Index, where the forecast is for the index to reach 325.1 compared to 324.05 previously, which would indicate continued inflationary pressure that the Fed will be monitoring closely. So while today is quiet, we've got a packed week ahead with employment, consumer spending, housing, and inflation data that could really move markets.
That's a lot to digest, and it sounds like by Friday we'll have a much clearer picture of where the economy stands. Lizzie, let's shift to our stock of the day, which is Amazon. The stock has had a rough go of it recently, down about 7% year to date and trading well below its 52-week high. Walk us through what you're seeing here.
Amazon is a really compelling case study right now, Robert. The stock is currently at £210.32, which puts it about 19% below its 52-week high of £258.60, and it's down roughly 10% over the past year. The recent weakness came after the company missed earnings expectations, and more importantly, guided to higher capital expenditures than Wall Street was anticipating. That spooked investors because it raises questions about near-term profitability and free cash flow generation. But here's where it gets interesting. The company is trading at a forward PE of 22.63 compared to a current PE of 29.33, which means analysts are expecting about 30% earnings growth. That's substantial, and it's based on the thesis that AWS will continue to grow, margins will expand as the company gets operating leverage from its AI investments, and the advertising business will keep scaling. The analyst community has a strong buy rating with a consensus price target of £283.65, which represents about 35% upside from current levels. That's a significant gap, and it suggests the market may be overly focused on short-term capex concerns while missing the longer-term value creation story.
So the question becomes, is this a buying opportunity, or are there legitimate concerns about the capital intensity of the business going forward?
It's both, honestly. The risks are real. Amazon is likely going to spend $75 billion or more annually on AI infrastructure, which is a massive commitment that will pressure free cash flow in the near term. There's also intensifying competition in cloud computing from Microsoft and Google, regulatory scrutiny that isn't going away, and macro concerns about consumer spending that could hit the retail segment. Those are all valid worries, but on the opportunity side, you've got a company with dominant market positions in e-commerce and cloud computing, a rapidly growing high-margin advertising business, and the Prime ecosystem that generates recurring revenue and customer loyalty. The forward valuation of 22.63 times earnings isn't expensive for a company with Amazon's competitive moats and growth trajectory. If you're a long-term investor with a 12 to 24-month time horizon, current levels look attractive. The realistic year-end target range is probably $260 to $285, which would give you 24 to 35% returns. That said, you need to be prepared for volatility because the market is still digesting these AI investment requirements, and if we get any disappointments on execution, or if CapEx guidance goes even higher, the stock could see more pressure. So it's a buy the dip situation, but with the understanding that the dip might not be over yet.
That's a balanced view. Let's move to crypto. Lizzie, what are you seeing in Bitcoin, Ethereum, and Solana as we head into this week?
The crypto market is in an interesting spot right now. Bitcoin is showing mixed signals. On one hand, we saw mining difficulty drop by the most since 2021, which indicates miners are capitulating under pressure, and that's typically a bearish sign. On the other hand, we're seeing whale accumulation with about 40,000 Bitcoin being scooped up during the recent dip to $60,000, and long-term value investors appear to be stepping in. Some traders are calling for a real bottom around $50,000, so there's still downside risk. But institutional players seem to view current levels as attractive. The sentiment is cautiously bearish for the next week, but with strong accumulation happening underneath. Ethereum is facing its own challenges, trading below $2,000 recently and dealing with ongoing scaling issues. The abandonment of the Ethereum named service Layer 2 plans highlights those concerns. The outlook here is neutral to slightly bearish, and the key level to watch is whether 2,000 holds as support. If that breaks, we could see more downside. Solana is actually holding up relatively better. There's still institutional interest, and the network continues to gain traction as a leading Layer 1 blockchain. The sentiment is neutral to slightly bullish, though it's not immune to broader market weakness. The institutional versus retail dynamic in Bitcoin is worth noting. Institutions are treating this weakness as an opportunity to add exposure at better prices, while retail investors are showing signs of capitulation based on search trends. That divergence often marks transitional periods in the market.
So it sounds like crypto is mirroring some of what we're seeing in equities, where there's near-term uncertainty but longer-term investors are finding value. As we wrap up, the key themes for this week are going to be those economic releases Steve mentioned, particularly the jobs report on Friday and CPI on Thursday, along with watching how both equity and crypto markets digest recent volatility. We've got a relatively quiet Monday to start, but things are going to heat up quickly. Remember, do your own research and consult with financial advisors before making investment decisions. Thanks for joining us on The Morning Bell. I'm Robert, along with Lizzie and Steve. We'll see you tomorrow.